You alluded a little bit to some of the debt structure used by the funds. You mentioned that 100% of the debt is fixed rate. Have you always done 100% fixed, or is that a change? And can you talk to us about your philosophy there?
Yeah, big picture to me, it's always been critical to match your hold strategy with your debt interest rate risk strategy. So, for example, if we're buying an asset and we expect to hold it, 7 years, then we should be trying to eliminate interest rate risk for that 7 year period of time as much as possible. So, in our prior funds, you probably saw fixed rate financing in the 70% range, where we'd lock it up for 7 to 10 years, kind of thing. And then maybe the other 30%, we would use floating rate debt, but we'd also buy interest rate caps, meaning that the interest rate, like right now, we had the short term rates went from basically 0 to 5.5%, but we bought a lot of caps that limit short term rate movement for 3 to 5 years to 2.5%. So we bought caps limited the risk of that floating rate debt. And when we did floating rate debt with a 3 or 5 year rate cap, we did that because we expected to sell that asset in the 3 to 5 year window. So you want to avoid prepayment penalties and other things that are expensive on unwinding debt. So the general philosophy, eliminate interest rate risk as much as possible in your strategy. Let us focus on how we can grow the business, how we can grow the rents, how we can reduce expenses, how we can grow the bottom line profitability of these properties, and not be taking much risk in the form of interest rate risk. And then on top of that, we just do lower leverage. Our industry allows you to go to 75 to 80% debt. We've been consistently in that 60, 65% debt range because I've lived through cycles. I mean, I've been around 35 years. I've seen what happens in cycles. And this time, there's economic impact as well as interest rate impact. And you can get really hurt. And the way you preserve your capital, the way you protect your capital is minimize that debt risk as much as possible, minimize that interest rate risk as much as possible. You can't completely eliminate it. In our older funds, we have interest rate caps that are now expiring at the end of this year and then next year. So you got to make sure that you can withstand that. But it's a much bigger difference if you're a 60% levered or 65% levered, and you lose 10-15% of your gross revenue. You still have no problem paying your bills, you know. But if you're 80% levered, you're in trouble. And then if you're 80% levered and you're floating rate debt, you're losing your equity. And the reality is these are cycles that run, and you just got to be able to manage through the cycles so you don't lose your capital in investing in private real estate. And you shouldn't if you're disciplined.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.